Well, November started off with FOMO in the air. However, when the 6:30 bell rang, it turned out to be just a big rug pull. Well, if you look at the index products, where did we finish for the day? Relatively unchanged. The Nasdaq 100 got hit the most, down 1%. Ugh. But what caused this nice FOMO move to get just obliterated? Well, we had construction spending come in significantly hotter than expected, and the JOLTS report came in hotter than expected, and even ISM numbers, I get you, it came in a little hotter than expected. Okay, and if things are coming in hotter than expected, why would the Fed back off? Speaking of the Fed, tomorrow is the Fed interest rate decision. If you look at the probabilities for what they're going to be doing, we're looking at a target rate of 375. We're at 300, so the probability is of a 75 basis point rate hike. Will they do it? I hear some people talk, well, yields are rising really rapidly. These guys are going to give us a surprise 1%. I mean, look at the yield curve right here. The 10 and 2 is minus 47 basis points. Yeah, totally, everything's fine. The 10 and 3 month, 10-year 3-month yield curve is at minus 16 basis points. It is not looking good, but the probability still points to a 75 basis point hike. So to see them go above that would be pretty shocking to the markets, I would imagine. But we're going to look out further. This is going to be an important one to pay attention to going into where we'll end the end of the year at. And right now we're pretty much at a coin toss for the most part, 50-50. Are we going to do another 75 basis point hike, or are we going to slow the rate hike down to 50 basis points? Remember, when that article came out by Nick Timiraos from the Wall Street Journal, this extra 75 basis point rate hike into the end of the year dove, and then the chances of a 50 basis point hike obviously increased. Now we're sitting about 50-50, but that really sparked that rally that we're seeing. Now, Powell, we got to see what the guidance is kind of going to be like, okay? It's like, what is he going to say? What is he going to do? Because last meeting, he quoted Volcker, twice, and he had mentioned that he has to keep at it until the job is done. Okay, Keep At It is actually the name of Paul Volcker's book. All right, so is he going to just kind of go crazy, hack nasty? Well, he's trying to fight inflation. And where is inflation? Well, the United States core inflation rate is still climbing up. It's at 6.6. Now, core inflation in the United States, the core inflation rate, it tracks changes in the price consumers pay for a basket of goods, which excludes food and fuel costs. Those are volatile, right? However, if you look at the United States inflation, or CPI, it's at 8.2%. So we peaked out here, 9.1%. And really, if you just look back the chart, like, people are calling this the peak, and it might be, but really, when you just take a look across the board, has it came off enough for the Fed to really like let off their foot off the gas? Okay, their target is 2%, and we're at 8%. All right, and how far are we from the high? 9.1. So we're down 1% so far. Okay, so yeah, I mean, I would imagine that they're going to be keeping at it. So it's going to be wild, to say the least. All right, now SPY has been on this monster run up, as you can see, just nonstop, very small, subtle pullbacks, and continues to move up. Today was down on the day, light volume, and that makes sense because we're coming into some event risk. Now, as we're walking into this event risk, let's see how the signals are all lining up. And this is pretty eye-opening, right? So we've been having this monster rally into now a big meeting. We have the bullish percent indexes that we're going to be looking at. Okay, this is for the Nasdaq. This is getting into overextended territory. Overextended could stay overextended for quite some time, but just understand that these overbought and oversold areas have marked turning points in the market, as you can see on the screen right there. So are we going to see this start to cool off here in the near future? Well, that's the Nasdaq composite. The Nasdaq 100 is also right there in that overextended territory. It's not quite there, but it's not too far off. BPSPX, the bullish percent for the S&P 500, it's at 78.43. That's getting pretty frothy. Dow Jones Industrial Average, getting pretty frothy. It's in the 80s. The technology sector, getting pretty frothy. It's at 76.66. The energy sector, getting pretty frothy at 72.68. Financials, 79.52. Now, why am I telling you of these specific ones? Well, one, because they're overbought, but two, financials and energy have been doing really well, and that makes up a big portion of the S&P 500. What's really been holding the S&P 500 up, because tech has been getting hit, has been these energy names and financials. So as we're getting over extended territory and these start to cool off, it begs to ask, you got to wonder, okay, what's going to happen if they come off? Is this going to be a bear flag and potentially start breaking? Well, we need to keep that at least in our mind, okay? And we'll go over the expected moves on what we expect is going to happen. Now, another thing to watch going into tomorrow is obviously the dollar. We talk about this frequently. The dollar has been on a monster move all year. It's one of the best assets to own, okay? It's been putting in higher highs and higher lows. So people are trying to call for a peak in the dollar. Okay, cool. I don't understand why you're trying to call for a peak in the dollar when there hasn't been a significant type of blow off top or any indication that we're really going to see the peak here. Can they be right? Yeah, but why bother making that assumption when we are quite literally maybe a couple of days off from another high, for 2022? I don't know. But when you look at this, what I want to call out here, which would be pretty crazy, is this, expansion move, and now we're contracting. The pullbacks are getting a little tighter. So if this starts breaking out, or if we break out sooner on tomorrow's news, who knows, the Fed could pivot and this dollar can drop off to the face of the earth. It can break this trend, and then the S&P 500 can rally. Like, that's always a possibility, okay? But as it stands right now, the dollar's holding up relatively strong. It's contracting. It's right over there at around the lower Bollinger Band, and if it starts breaking out of this compression pattern, this is what's going to happen to the S&P 500. Chances are it's going to go down. Why do I think it's going to go down if the dollar goes up? You can look right here at a correlation chart, okay? On multiple different time frames, we have the 15-day time frame, 30-day, 90-day, 120, and 180. And you see these little negative signs right here: negative 86, negative 80, negative 68, negative 0.54, negative 0.81, and so forth. That means that the correlation between the S&P 500 and the dollar are negative, right? Are negative. So that means when the S&P 500 or when the dollar moves up, the S&P 500 has an inverse correlation, right? It goes down, and you can see that across the board on multiple time frames. So watch out for that dollar. Now, if we dig into the charts, 15-minute time frame, you're going to see some lines on the screen. First and foremost, I'm running out of breath. Holy moly. The orange lines, that is the expected move going into tomorrow's Fed decision, okay? So right here, it's plus or minus 6.1. So I just put that on the screen. It takes us to around 390 and then down to around the weekly expected move. Those are the orange lines. The black dash lines, those are the weekly expected moves. So if we do crack down to these levels, we'd be tagging the Fed rate hike decision, lower level, and the expected move. Now, this doesn't mean that it tags it and all of a sudden bounces from those levels. It's a good idea, to understand where these levels are from a risk management perspective, but always be aware that you can have 2 sigma, 2 standard deviation type moves. Now, another thing to call out is we have a little small bear flag forming right here, and price is just doodling around that 5-day moving average, which is inclining. From a positive note, I will say that we still have a series of higher lows on the shorter time frame. So if these start getting cracked and start heading down, that could be, bearish sign, obviously, for the S&P 500. You can potentially call out here as a left shoulder. You can potentially call this as a head. And if we start breaking down something like this, and we come down and we're like, oh, we bounce and everything's fine, it could actually build out a potential right shoulder, as you can see, something like that. And this could very well be, a head and shoulders type pattern. And if that cracks, where do we go? Well, we go right back into the chop box that we've been talking about on various other episodes, okay? If you take a look at the Qs has a $5.50 move, we'll call it. Also a very interesting bear flag structure. This one hasn't moved anywhere. It's still in the chop box. It still has a possibility of an inverse head and shoulders, so it's still bullish, potential bullishness building, right? But we still, from a bullish perspective, you want to get above 285. If you get above 285, you got to look at that weekly expected move right up here at around 292.50. That orange line right here, that is where the expected move is going into the Fed rate hike decision, which also lines up with what? Just about that lower weekly expected move too. And remember, we've seen plenty of times where we get outside of the weekly expected move and it comes up and then might act as a level of resistance. It's just interesting to, levels to keep an eye on as you're moving into this type of event risk. Let's take a look at IWM. So I want to call out here. We just saw a bear flag in the S&P 500. We're seeing overextended areas on the bullish percent indexes, and we saw a bear flag on the Qs as well, the NASDAQ 100. Now, the IWM has been holding up relatively, stronger, which is a good sign because typically going into bull markets, you want to see small caps perform better. Okay. Another way of thinking this is as we're heading into event risk, hedge funds are are what? Covering their shorts, which makes obviously IWM go higher. Meanwhile, they're selling off their biggest positions, which are typically what? Big mega cap stocks, and those are going down. Actually, Meta was down like 5% again today. You know, I don't even know if that's considered a mega cap anymore, but still it's a big name and a lot of people trade it. Now, bear flag, what do we got going on here? IWM is a rising wedge structure where we get this expansionary type move to the upside, and now price is kind of coiling up on a negative divergence, which means, hey, if we break down, it could very well hit the Fed move, which is right around 180. If we go to the upside, it's right about 187, and then we have our weekly expected moves here. So as you can see, we are out of the chop box, which, you know, I still have highlighted down here, but it's always a possibility that, hey, if we come down here, that would be a dramatic move, right? 176, but where would that put us in context of everything? Well, it actually put us still having, you know, one low, a higher low, and that could be very well a higher low too. So the IWM is, you know, is ahead of the game. Even if we get a strong pullback into prior areas of resistance, it could offer up good opportunities to potentially buy. Now, I wouldn't buy necessarily just, you know, the moment, like say if the news comes out very bearish, hawkish, whatever, comes right down here and you'd be like, okay, now I'm going to buy because, you know, that's, you know, you want to wait, you want to be patient, right? That would be under the 5-day moving average. You would want to see price firm up and actually, you know, do something like that where it can potentially, you know, build out some sort of a base. Then you buy outside of it, right? So you can have a tighter stop loss and say, okay, now I'll have a stop under this low, you know, or this low, or maybe I'll do a 50% stop under this low and a 50% under this low and see if that holds. And then we start moving back up. So you want to be patient. You don't want to just try to, you know, catch a falling knife, because if you remember last time the Fed came out and talked, you know, at Jackson Hole, it pretty much went straight down very violently. Now, a couple other notes here is the Pring bottom fisher. It's starting to make a turn. We talked about when it was making a turn here, marking out a potential bottom. Took a little while, but it did rally up. So it's something to note, but this is called the Pring bottom fisher. So it's for finding bottoms, not really for marking tops. Another note is the summation index. Still pointing up here, so that's a positive sign. Parabolic SAR is beneath us, hasn't even started to curl over, but on a negative note, it is still below zero, so you got to take that into consideration. You want it above zero, you want it trending above, that'd be positive. But if you look at the Knight-McClellan oscillator, we are in that 250 range, which actually has marked off turning points, and the reason why is because it's considered overextended territory. So if you look at those areas, it was right here on the New York Stock Exchange and right here, and now we're back there again. So it doesn't necessarily mean that the market can't go higher, but it could be, you know, after this very strong move up, it could look for a period of consolidation before its next leg higher, or it might just get hit. We do not know yet, but this is how we have to manage risk. One last thing I want to talk about is the zones. I'll share these. I share these with my Patreon group. If you want to sign up, $9 a month. Obviously, there's no contract. If you want to do annually, you get 16% off just by making that commitment, and it ends up being like $90 US. You'll get the zones, which I'm still doing at this current time. I haven't put them in here. You'll actually get my stock market indicators. I have a big list of indicators, the ones that I go over on these shows. So you have permalinks to all of those. You'll get trade ideas. You'll get weekly expected moves. You'll get the watch list. If we take a look at the zones, one interesting thing that I'd like to note here is that the downsides on a lot of these products are getting significantly higher. So be aware of that. Like, for example, if we take a look at, I'll take a look at financials and energy, which we just recently stated, the BP charts on those. We're looking at, you know, 7% downside, 9% downside in energy versus, you know, a 3% upside in energy and versus a 3.5% upside in financials. You can even look at the Qs. The Qs are basically at about the midpoint there, so not much going on there. But this isn't like, that doesn't mean it's probable to hit these lower levels by any means. It's just a good risk management tool to understand that, hey, where can these potentially end up? These are dynamic, they're constantly changing, but it does help out me navigate these markets a little bit better. So that's all I got for you on today's episode, everybody. Hope it helped out, and stay safe out there. It's going to be very, very volatile.